This is the first in a series of two videos on the AI Volatility Edge platform, abbreviated AIVE for short. The AI Volatility Edge platform is an integrated collection of 80 AI models that were developed with the latest machine learning algorithms and proprietary training techniques. The primary purpose of this video is to provide an overview of the AIVE platform and to demonstrate how the actual AI forecasts on a specific date could be analyzed and interpreted. The video is intended for prospective and current AIVE subscribers. The AIVE platform is offered by Trading Insights LLC, and both professional and non-professional subscriptions are available. I am Brian Johnson, and I have over 30 years of experience as an investment professional, as an institutional fixed income portfolio manager, as the president of a financial software development firm designing AI forecasting tools for investment management firms, as a professor of practice designing and teaching graduate and undergraduate level derivatives classes for business schools at 3 different universities, and as a proprietary derivatives trader and the author of 4 books on options. In this demo, we will begin with a review of the AIVE models, followed by a discussion of the limitations of AI and an overview of the specialized training methods used to build the AIVE models. Next, I will demonstrate how to generate, analyze, and interpret AI Volatility Edge forecasts using actual market data, and I will present a sample trade. Please see the second video in this series for a detailed instruction on how to enter data and operate the spreadsheet, which will not be provided here. The AI Volatility Edge platform provides 4 different types of volatility forecasts for 3 different indices. The indices are the SPX, the S&P 500, the NDX, the NASDAQ, and the RUT, the Russell 2000. The 4 different types of volatility forecast are 1. Realized volatility, 2. Volatility index prices, 3. Realized terminal volatility, and 4. Realized extreme volatility. In order, realized volatility represents the annualized root mean square of the daily continuously compounded returns of the underlying index. Again, either the SPX, the NDX, or the RUT. So what does that mean? It is an annualized estimate of how volatile the underlying index is. Why is that important? It's important because the realized volatility forecast can be compared directly to the implied volatility of an option to determine whether that option is cheap or rich. Similarly, the AI Volatility Edge platform provides an estimate of the volatility index price in the future. The estimate of where that volatility index will be in the future can then be compared directly to futures prices of that same volatility index to determine whether the futures prices are cheap or rich, identifying a potential opportunity for value added. In addition, the AI Volatility Edge platform provides a realized terminal volatility. Realized terminal volatility is the expected price change or return, continuously compounded, of the underlying index between now and some specified time into the future. And again, the Volatility Edge platform provides estimates for today, 0 days, 5 trading days, 10 trading days, 15 trading days, all the way out to 504 trading days in the future. So for each period into the future, the AI Volatility Edge platform provides 4 different volatility estimates. So again, going back to realized terminal volatility, or RTV, if that number represents a 5% is calculated, or the forecast is 5% over the next 21 days, what that means is the model is forecasting a plus or minus 5% change in price of the underlying equity index, plus or minus, it's not directional, plus or minus over the next between now and 21 trading days into the future. The realized extreme volatility is similar. It is also forecasting the change in the percentage change in the underlying index, but it represents the maximum interim change in the return of the underlying index over that same 21 trading day period. So for example, if the realized terminal volatility was expecting a plus or minus 5% price move, the realized extreme volatility might be plus or minus 7%. So on average, we're expecting prices to move by up or down by 5% between now and exactly 21 days into the future. But sometime within that 21 days, we would expect prices to move as much as plus or minus 7%. Why is that important? Because when we're setting up, for example, an option income strategy like a butterfly or an iron condor, we need to know how much we expect prices, the price of the underlying index, to move over the holding period of our strategy. That basically helps us with strategy design. So fortunately, it is very easy to interpret the model forecasts. Let's take an environment where volatility is underpriced. In this example, realized volatility might be 20%. The at-the-money implied volatility of, for example, a 21-day option would be 15%. In that case, realized volatility is 20. The at-the-money implied volatility is only 15, which is underpriced. We would therefore be expecting the level of volatility experienced over that next 21 days to be greater than the implied volatility, or what we're paying for the options, and as a result, we would expect to outperform with certain types of long gamma strategies. Similarly, if the VIX forecast or the volatility index forecast was the same 20%, and let's say the VIX futures price 21 days into the future was only 15%, so we had a 20% forecast, a 15% VIX futures price, and as a result of that, we would expect the VIX futures to go up over that next 21-day period by approximately 5% and hopefully more, and as a result, long Vega strategies would be appropriate. So in that example, what we're talking about for that type of environment where volatility is underpriced, long straddles might be attractive, long strangles, long options in general because they have positive Vega and positive gamma, long VIX futures contracts or some types of VIX option spreads, all of which would be appropriate to benefit from a higher than expected level of realized volatility and a potential increase in implied volatility and the VIX as well. Conversely, if volatility is overpriced or rich, in that case, we might have a realized volatility forecast of only 10% compared to that same implied volatility of 15%. In that case, we would be expecting a much lower level of volatility to be realized over the next 21 days. And in that environment, a short gamma or positive theta position would be appropriate. Similarly, if we were expecting a 10% VIX forecast compared to the current 15% VIX futures level, a short Vega position might be appropriate as well, where we would benefit from a decline in implied volatility. Those types of strategies would be your typical option income strategies, short iron butterflies, short iron condors, many different type of option income strategy variations, and also potentially a short but covered VIX future strategy might be appropriate as well. Let's move on and talk about artificial intelligence, or AI. AI is extremely powerful, and actually perhaps too powerful. Unfortunately, in addition to that, we have a limited ability to understand the AI process, and we cannot debug AI models as well. So the reason is it's not a conventional piece of software. It's actually like a nonlinear matrix, supersized matrix algebra problem. And our only solution is to be able to try to force the AI models to generalize and not memorize data. So in effect, I've adopted over the past 20 years a number of specialized training methods, which I've actually applied to the AI volatility edge models. Specifically, one, Limit the number of explanatory variables. The more power you provide an AI model, the easier it is for it to basically memorize the data and not generalize on the underlying relationships. The second epiphany, if you will, was to use the same explanatory variables for every model. So we have 4 different volatility estimates over 15 different time periods, if you will, but I've used the same explanatory variables for every model. That limits, again, the power of the model and reduces overfitting. Third, we have a testing or validation set that's actually much larger than the training set. So when you design an AI model, you provide it the data, which it learns from, but you withhold data from that set to test or validate outside of the learning process. And as a result, I've learned that maintaining a much larger testing and validation set, again, makes it much more difficult for the model to memorize, because we're essentially comparing it to the testing or validation data set to ensure that it is, in fact, generalizing on the relationships over the entire 20-plus year time period. The fourth method that I used with training the AI VE models was that I used a single aggregate model for the SPX, NDX, and RUT. It would be, in some cases, logical to actually build an SPX model, build an NDX model, and build a RUT model. There's a logic to that because the implied volatility structure is actually different. But by being able to include the right types of variables that's able to explain the structural relationships between price changes and volatility and implied volatility, I was able to use a single model for all 3, and as a result of that, that effectively tripled the amount of data observations that I had access to historically, which once again made it much more difficult for the model to memorize and forced it to generalize on the underlying relationships. Number 5, severely limit the number of training or optimization iterations. The longer you let the models train on the same data set, the more they will hone in on obscure minor deviations in data, in the data set, in the training data set, and as a result of that, they will lose their ability to generalize. And finally, one of the main concepts that I learned over 20 years ago in working with AI models, I applied to the volatility forecasts, which was we have 3 different AI models for every AI forecast. And instead of using just one, we use 3 different models which calculate the weighted average of each one to come up with a single estimate. This reduces outliers and it results in a much better and more generalized estimate of what the expected future volatility will be, rather than just relying on a single AI model that we cannot debug. The purpose of this video is analysis and interpretation, not data entry, so I will move through those elements quickly. Please see the second video in this series for a detailed explanation of the AI VE user interface. Okay, we are on the All Data tab, and on this tab, we need to, 1, accept the terms and conditions. 2, we need to enter the monthly password, which I've done here. And 3, we need to click on the Clear All and Calc Off macro. That brings us over to the IV Data tab. From the IV Data tab, I'm going to use the free data option. Again, this is discussed in detail in the second video. So we're going to import the CBOE IV data, which is required for our analysis. We're going to move to the Price Data tab, where you're going to input the Yahoo price data, which has been previously downloaded from Yahoo. And that populates those fields. We're going to move to the AI Forecasts tab. We're going to turn the calculations back on. And at that point, we are now ready to generate the general AI forecasts using the model. The next stop in the process is to select an analysis date, which I've already done, of 10/1/2019. We then clear the output data, calc the AI volatility forecast using the push button macros, and if necessary, set the chart minimum and maximum. And that populates all graphs and tables. So what we see here, if we highlight it, is going to be the number of trade days into the future, or potentially the past as well. So 0 days, 5 trading days, 10 trading days, and so forth. And for each one of those, we have the realized volatility forecast, the VIX forecast, the realized terminal volatility forecast, and the realized extreme volatility forecast, all for each one of the days into the future. In addition, I've also calculated and provided the historical volatility for 5 trading days in the past, 10 trading days in the past, 15 trading days in the past, and so forth. So that's the tabular data, if you will. I'll go through the analysis in more detail on the analysis worksheet once we actually get to this point, but these are actually just general forecasts for the general number of trading days in the future, so I don't want to go into much analysis now. We'll save that for later. So the next table that I want to look at are the error terms, which you can see here, which again are the root mean square error, the average error for each one of the models, the RV model, the volatility index model, the terminal volatility model, and the extreme volatility model. The reason we need the error terms is ultimately we're going to be interested in the standardized deviation, or being able to standardize our differences between our forecasts and actual data. And to do that, we're going to need to know the model errors, if you will. You'll notice that those are out of sample model errors, with the exception of the regression errors for the extreme volatility model, which uses data input from the 3 other models, if you will. So in addition to the tabular data, which is available, we actually also look at graphical data, which is in many cases easier to understand. So in this case, we actually have the volatility forecasts for the volatility index in red, and we actually have the at-the-money implied volatility forecasts in blue. The historical volatility is also presented in graphical format, so let's take a look at that next. We scroll down, we see that the annualized volatility is for each day, 500 days into the future, 400 days in the past, 300 days in the past, 200 days in the past, and so forth. So a long-term historical volatility was around 15%. It increased, it dropped slightly down into the 13% range. It spiked over the last 42 trading days or so. It plummeted, and then now it's actually increasing again. So that's what we see. It's a picture of the historical annualized volatility for the past X number of trading days. Now, we talked about this next graph before, which is the terminal and extreme volatilities expressed as a rate of return. So on the x-axis represents the number of trading days into the future. The y-axis indicates the expected terminal price change of the SPX in this case, which is the dashed line, and you notice again it's plus or minus. And the solid lines are the extreme levels of volatility. So using that, we can go however many trading days we would like into the future, and we can see that the expected price change of the underlying index, the maximum expected price change over the interval, and the expected price change at the end of that time period are all shown for each one of the trading days into the future. In addition, we also have that same data in tabular format. So in addition to the graphical format, we have the same data in tabular format as well. So we can see the specific values. And I'm going to scroll down further, and we can see that same data in price. So now on the left-hand axis, instead of rate of return, we see the price at the SPX noted X number of trading days into the future. And if you want to know the specific values, we could actually look at the tables. Again, I'm going to go into this in more detail and a more thorough analysis once I actually move on to the analysis tab. But for now, since these are just general dates into the future and don't correspond to specific options or futures contracts, I just wanted to give you a flavor of what's actually presented on this page. All right, so let's move on next to the Estimate TSV tab, and we'll discuss that briefly before going on to the Analysis tab. This optional worksheet uses Solver to calculate the implied forward term structure volatilities from the implied volatilities of at-the-money equity index options and from volatility index futures prices if they are available. I recommend entering data on this worksheet and importing that data into the analysis worksheet because the monthly, option, and future expiration dates are automatically populated on the Estimate TSV worksheet. These are the dates that are located here. So these are the monthly expiration dates for the equity options. These are the monthly expiration dates for the VIX futures contracts. If you enter data here for the at-the-money implied volatilities, enter the futures prices in this column, then use solver to solve for the best fit, if you will then be able to use that same data and import that data directly into the analysis worksheet. So please see the second demo and my upcoming book for a more detailed explanation of how to use this tab or this worksheet. But for now, let's move on to the analysis sheet, which uses this actual data to perform a rich cheap analysis for the entire term structure of volatilities. Now that we're on the analysis sheet, it is good practice to clear the input data from any past runs. So I'll do that first. We'll import the term structure volatility data from the Estimate TSV worksheet, and that will automatically do all of the calculations and rich cheap analysis on this sheet, which we'll explore in detail. And finally, we can set the chart axis min maximums as well to make sure all our charts are visible. Okay, you'll notice that the analysis date is 10/1/19. That data is actually populated from the AI forecasts worksheet because by definition we're using those same general forecasts, but now we're actually using them to compare to the prices of actual at-the-money equity options and VIX futures contracts to determine what's cheap and what's rich. All right, so let's begin with evaluating the table in the spreadsheet or worksheet that evaluates the rich cheap analysis of at-the-money equity options. So what we see here on the left-hand side are the option expiration dates. We see the number of trading days into the future for each one of those options. This is the data that we imported from the TSV worksheet, which are the implied volatilities. The next column are the AIVE forecasts. Finally, the error column, which you'll notice is all in red, representing overvalued, is the difference between the implied volatility and the forecasted realized volatility in percentage terms. So let's just look at one example, which we're going to go into a little bit further. But let's look at the option expiring on 12/20/2019, 57 trading days into the future, had an implied volatility of 16.7%, had an estimated volatility or forecast of 12.45%. That's a 4.25% difference. The standard deviation was 5.47%, so that 0.78 standard deviations, or a sigma or z-score of 0.78%, and a one-tailed probability of 21%. So that in market space, that's a relatively significant event. So two things to note is, one, that option is significantly overvalued relative to the AIVE forecasts, and in addition, every single one of those options is overvalued as well. So if we move over to futures, I'm going to have to move the spreadsheet a little bit over to do that. So moving over to futures now, we see the same type of analysis. So we see the futures contract expiration dates. We see the number of trading days into the future. We see the futures prices. And in this case, let's just analyze the 11/20/2019 contract. And what we see here is, if I'll double click on it and bring it a little closer, that's 36 trading days in the future. Futures price was 19.18. 15.9 was the forecast. That's an error or deviation of 3.28% relative to a standard error of 5.14, 0.64 standard deviations. So again, the majority of those contracts are in fact overvalued with only one exception, which is the contract that expires in February 19 of 2020. So what we can see from this is that the options and almost all of futures contracts are overvalued. So this seems to be an ideal environment for basically selling overvalued or overpriced volatility. If we scroll down, we see that same information is presented graphically as well. So first, we'll take a look at the at-the-money implied volatility analysis graphically. So the blue line is the actual data on the right-hand y-axis. The green line are the forecast implied realized volatilities, also on the right-hand axis. And the red dots are basically the error terms and standard deviations, but this time they are on the left-hand axis. So the observation that we were looking at before, which represented 0.78 standard deviations, is up here. So we can actually see that the entire curve is overvalued and basically indicates that volatility itself is overvalued, and that is one security that we should be focusing on when we actually build our strategy. So similarly, if we scroll down, we can take a look at the same curve or same analysis, but this time we can take a look at the analysis for the VIX futures. So if I turn my graphics back on, I can highlight that. And what we see here again is the blue line represents the VIX futures prices off of the right-hand axis. The green line represents our forecasts, and the red dots represent our error term. So this is the error term, or the VIX futures contract that I looked at before, which was overvalued by 0.6 standard deviations. So again, we see that data graphically, we see it in tabular format, and it gives us an insight as to the level of overvaluation or undervaluation across the entire term structure of volatilities, and looking at each individual option or futures contract as well. All right, let's move on and take a look at the terminal and extreme returns and prices. I showed you this information before on the AI forecasts worksheet, but now we're actually on the analysis worksheet. So each one of these observations corresponds to a specific option or futures contract. And again, what we can see here is the expected range or change in return for the underlying index for each one of these time periods. So we were looking at the December time period to potentially construct a strategy from. We can see the expected price changes listed here. And if we look at the actual table, we can read the observations directly for those securities from the table itself. So we can know what the expected plus or minus maximum price change we would see over that period, and also the expected terminal price changes as well. Scrolling down, those were expressed in rates of return, but we can see the same charts in the SPX prices, which would be useful in constructing our strategy when we're actually selecting strike prices for short and long legs of each strategy as well. All right, at this point, let's move on to an actual trade example. We've identified an environment that has volatility that is potentially overpriced. We've identified December options as being potentially the most overvalued. So let's create a targeted strategy to exploit that potential pricing anomaly. What we have here on the left-hand side is a trade entry profile from OptionView as of 10/1/2019. The green lines that you see there represent the P&L and payoff diagrams for a broken wing butterfly, and the trade is approximately a $20,000 position, just for an example. And you can see the Greeks are listed here as well. So the Greeks are positive 10 for delta. Gamma is negative 0.13, Vega is negative 464, and Theta is positive 25.67 on a per day basis. So these are all calculated by OptionView. So you'll recall that in an overpriced volatility environment, we are expecting a lower than expected level of realized volatility. So in that case, we benefit from a negative gamma, hence a positive theta position, which are again direct opposites. We would also expect implied volatility to decline over time given our forecasts, so we have a negative vega position. So the other thing to take into consideration is, and this is a decision that I made just for example purposes, is delta is positive. The reason that I've shaded the delta to be slightly positive, so it's kind of a slightly directional broken wing butterfly, is that we're expecting a significant decline in implied volatility, and the price of the underlying, which is the SPX, are highly negatively correlated. So given that I expect volatility to decline significantly, shading the option income strategy slightly delta positive in this case is consistent with that negative vega position. So again, what you're seeing here is our ability to target trades to exploit specific anomalies that exist in the term structure of volatilities. So that's the trade entry, about a $20,000 trade. We're expecting a lower than expected level of realized volatility, a potential decline in implied volatility, which is the reason for the negative vega, negative gamma, and positive theta position. So what we see here on the right-hand side is the same diagram as of the potential trade exit date on 11/1/2019. There are no adjustments. You can see that the net requirements, again, is approximately a $20,000 trade. Over that 30-day time period, it was a gain of $3,189, representing a 16.45% return on required capital. I won't go through the Greeks because that's actually not the reason for exiting the trade. The reason for exiting the trade at this point is essentially I reran the AIVE analysis, looked at the new forecasts, so the same tables and graphs that I showed you earlier. I won't go through them now, but they are explained in detail on the website. Did the same exact analysis, and essentially the edge that we had in our trade on 10/1 no longer existed on 11/1. In addition to the edge no longer existing, we've obviously had an attractive profit on the trade, but you'll also notice that we're actually heading towards the right-hand side of the diagram where the bulk of the gains, if you will, are basically in the center portion of the diagram. So our risk has increased, our return, our expected edge has decreased. That's the rationale for exiting the trade, and essentially we were able to target an implied volatility environment that in fact volatility was overpriced, and we were able to potentially exploit that. So the purpose here is not to show one positive winning trade. The purpose here is to show how the AI Volatility Edge platform and the forecasts and the standardized rich cheap analysis can be used to target potential mispricing along the curve, understand the volatility term structure along the entire curve, and potentially identify trades that represent anomalies in volatility pricing and potentially exploit them in practice. So again, that completes our trade example. Let's take a look and wrap this up on the last page of the presentation. This video has provided an overview of the AIVE platform and demonstrated how the actual AI forecasts on a specific date could be analyzed and interpreted. Please take the time to view the second video in this series, which explains in detail when, where, and how to enter data into the spreadsheet. Volatility is arguably the single most important option concept. Unfortunately, modeling volatility is an extremely complicated challenge, but one offering unique trading opportunities. The AI Volatility Edge platform is an integrated collection of 80 AI models that were developed with the latest machine learning algorithms and proprietary training techniques. A comprehensive description of the AI Volatility Edge platform, including numerous trade examples, is available at the Trader Edge address shown on the screen. New AIVE subscriptions for both professionals and non-professionals are also available at the same Trader Edge address. Finally, you will also find blog posts, links to my other books, and links to discount offers from affiliates, including OptionView and CSI, which I use in my proprietary trading. I hope you found this video to be interesting and informative. If you have any questions about the AI Volatility Edge platform, please contact me via email at bjohnson@traderedge.net. Thank you.